You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is commercial real estate investment expert and CEO of Convergent Capital Partners, Santosh Govindaraju. Santosh is the Chief Executive Officer and founding partner of Convergent Capital Partners. He's responsible for the strategic direction and growth of the company. Now, his responsibilities include negotiating acquisitions, overseeing all investment activities, financial affairs, investor relations, and forging partnerships with other firms in the industry. Santosh is a member of the Samuel Zell and Robert Lurie Real Estate Center at the Wharton School of the University of Pennsylvania, the Committee on Foreign Relations, and Leadership Florida. He serves on the board of directors of the IndoUS Chamber of Commerce, the board of directors of Asian American Chambers of Commerce at Tampa Bay, and the board of directors of Chinmaya Mission Tampa Bay, and the board of trustees at the Academy of the Lakes, all of which are in Florida. Santosh graduated from the University of Pennsylvania's prestigious Jerome Fisher Program in Management and Technology with a Bachelor of Science in Economics with concentrations in Finance and Entrepreneurial Management from the Wharton School, and Bachelor of Applied Science in Systems Engineering from the School of Engineering and Applied Science, and minors in Theater Arts, Mathematics, and South Asian Studies. And so here's what you're going to learn in our interview with Santosh today. You're going to learn how Santosh got his start in small value-add residential projects before transitioning into larger commercial assets. You'll learn why Santosh prefers to invest in value-add A-class assets versus B and C grade investments. You're going to learn about the opportunity in capital-starved investment properties and how Santosh and his team have been able to capitalize on these distressed A-class properties. You're going to learn about a few of the key principles that Santosh attributes to he and his team's ability to weather the 2008 recession. Additionally, how these same key principles will be applied as we make our way through these volatile times resulting from the COVID-19 virus that is currently sending shockwaves through the country. You can learn where Santosh feels that there might be a good buying opportunity once the dust settles from the coronavirus. And we're going to learn about the importance of maintaining a positive outlook and a healthy lifestyle during these turbulent times, and much, much more. And so, guys, with that, I'm excited to get on to the show with Santosh. But before we do, I have a few quick housekeeping items. Now, typically, I start this off by going through my one personal and one professional best of the prior week. However, given the turbulent, uncertain times that we find ourselves in here with the COVID-19 virus or the coronavirus, I want to share a recent post that was made on Facebook by a very close friend of mine, Jason Medley, as it relates to the coronavirus and us real estate investors. He says, I see a lot of cocky real estate investors that are influential people spouting off as if they have it all figured out, yada, 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 about the coming opportunity that will happen. This is arrogance at its best, and arrogance will always eventually be met with humility. Humility is your best friend right now. No sweat, it's all good. I've got cash flowing assets, so I'm safe. No, you're not. None of us know how this will shake out, but here's what I do know. Most businesses can't make it for 2 months without cash flow, and the people that work for them can't make it 30 days without a paycheck. And those people are the ones renting from you. If we shut the world economy down for any given period of time, there are only two things you can count on, and neither of them is cash flow from rentals. You could figure out the rest of the story without me explaining it, but you get the point. During times like these, you must understand your influence is a gift. If you're going to swing that influential sword, make sure you do so with careful consideration. Opportunity often straddles the fence between taking advantage of people or helping them. Make sure you know which side of the fence that you're on. Now, to sum this all up, guys, what I can say and how I interpret this is to proceed with caution over the coming months. This applies to both you passive and also active investors, depending on what side of that fence you're on. Are you a passive investor, active, maybe a little bit of both? A rising tide lifts all boats. And up until this point, the economy has done a great job of propping up investors and sponsors with record-setting ROIs or return on investments. But with the potential of the changing tides ahead, It's your responsibility to be a prudent investor and be selective with the types of assets that you invest in. But of equal importance, do your due diligence on the sponsors. Additionally, now is not the time to be chasing heavy value-add projects or higher risk investments, which are the majority of what I see being pitched nowadays on the different social media platforms, LinkedIn, Facebook, what have you. If you've been a regular listener to the show, then you'll know that my team and I, we've been working on some exciting things behind the scenes with the intent of rolling out an offering here in the coming months. Well, today, more than ever, we believe that mobile home parks are one of the most recession-resistant. Now, make sure you understand, resistant, not proof, recession-resistant investments that exist. And that belief is just as true today as it has been for the last 8 years that we've been investing in this asset class. Now, in addition to mobile home parks, we have spent the last year studying a new asset class, or new to us at least, that has us equally as excited as we were the very first time we came across mobile home park niche 8 or so years ago. And no, guys, it's not self-storage, it's not retail, it's not multifamily. In fact, I'm nearly confident that most of you wouldn't be able to guess it given the chance. So stay tuned, and soon enough, I'll be sharing with you an under-the-radar asset class that offers many of the same benefits of mobile home parks, but that also brings with it the security of income that a 10-year triple net lease with an A credit tenant has, similar to that of a CVS or Walgreens or Dollar General, Starbucks. The list goes on and on. So guys, that's all I'm going to share for now, but just stay tuned. We're going to be divulging more information as we get closer and closer to the release of that next offering, again, which it will be this new asset class, or new to us asset class, paired with mobile home parks. We're looking forward to sharing all the intimate details with you when the time comes. Now, moving on here to my personal best. On March 13th, that was my birthday. So just this past week, I celebrated my 41st birthday. And simply put, I'm just incredibly blessed to be surrounded by just incredible family and friends. And although we had to cancel my birthday celebrations due to the coronavirus, I was just as happy spending my special day with my wife and my 2 boys with dinner at home and a good movie, and also maybe a bottle or 2 of wine. So it was a great night. I'm kind of a homebody anyway, and so I was completely content with hanging out at home with them. And so it was a great day all in all. As far as the professional best, our team at Sunrise rocks. Okay. Sunrise Capital Investors, which is our company, our team absolutely rocks. And in the last few weeks, we have gone remote. And not only did we not skip a beat, but our entire staff has absolutely rallied and is kicking butt and taking names. And so I'm 100% confident that not only will we survive these trying times ahead, but we'll thrive. And so I'm just super excited for what the future has in store for us. I know that we're going to be going through some shaky times here over the coming months as we go through these uncharted waters of the COVID-19 virus, coronavirus. But I'm confident we've got the right team in place and that we will push through this storm and we'll come out a stronger company because of it. And so moving on here, guys, if you love what we're doing here at the Real Estate Investing for Cash Flow podcast, please take a moment. If you haven't done so already, leave a rating and review on the show. It really helps us grow the show and attract awesome guests such as Santosh. So it only takes a minute. Please do so, and I would be eternally grateful for you if you did. Lastly, here before we get rolling, I want to remind you of the free 30-minute call that I offer to the listeners each and every week. This is where I set aside 2 30-minute time slots where you can jump on the phone with me and talk everything and anything regarding real estate investing. Okay, there's no ulterior motives here. It's simply for a way for me to connect with my listeners who share a similar passion for real estate investing as I. And it doesn't matter if you're brand new, just getting started, or if you're a seasoned investor and you just want to connect and talk shop. I'd love to chat with you. So go to my website, kevinbupp.com, schedule that call, and I'll look forward to connecting with you. And now, without further ado, let's get on to the part of the show that you've been waiting for, which is our interview with Santosh. So here we go. Alrighty, guys, it is my honor to introduce my guest for today's show, commercial real estate investment expert and CEO of Convergent Capital Partners, Santosh Govindaraju. Santosh, how you doing today, my friend?
I'm doing well, thank you.
Fantastic. We're very much looking forward to having you here on the show. And we find ourselves in some uncharted waters as we do this recording with the COVID-19 virus and all these crazy changes that have come about just over the last couple of days and the last couple of weeks. And I'm sure there's going to be a lot more that's going to be unfolding here in the future. And so we definitely are going to be chatting about that here today in the show. But with that, Santosh, what I'd love to do for those folks that aren't familiar with you, that don't know who you are, your company and your background, maybe take a few minutes so that we can get a little bit more of an understanding of you as an individual and as your company, who you are and ultimately what Convergent Partners does.
So I think it starts from my background. I started investing in the 90s and I had the privilege of studying at the Wharton School of Business for my undergraduate study. And during that time, I focused my time and energy on learning how to be a great investor. I knew that after graduation, I wanted to be on my own and invest my own capital alongside other investors. And so I focused on investment principles, and I was really grounded in the fundamental approach to investing, kind of the Warren Buffett methodology of value investing.
Mm-hmm.
And so after my undergraduate studies, I worked on Wall Street for a year, learned some additional investment principles, working in the fixed income division at Lehman Brothers. And at that time, Lehman was number one in the world in fixed income. So I've always benefited from working with the best of the best and competing with the best of the best and learning from them. And I came back to Florida in late 1998. In 1999, as I looked around, I saw that real estate was a really deep, deep value at the time. And so at that time in late 90s, a lot of real estate owners had been shy at raising rents and remembered the painful bruises they had from the 1990s recession, 1990. And so real estate was still a big value, deep value. And so I was able to buy a bunch of single family homes, triplexes, quadplexes, and so on. And at the time, you could get between 90 to 100% financing. So as a young guy, with good credit and some savings, it was a great opportunity to pick up a lot of real estate with a lot of credit flexibility. And so I've grown this firm. We remained a value investor. We've shifted from obviously those early days of single family and triplexes and quadplexes to multifamily, to office, to development of condos and townhome communities, to owning hotels and a wide range of real estate assets, to where today we primarily own Class A assets. But I still have I'm grounded in my experiences from building communities ground up, from owning Class B properties and Class C properties. The lessons I've learned there and succeeded with still prove invaluable today. And so the firm we have today actually has its origins to 1999. And, my business partner, Paul Bearquit, has been my partner for 21 years now from that time. We have employees who've been with us for 15, 16, 17 years. And so it's those people have been on this journey with us through the volatile times through 9/11, through the crash and the financial crisis in 2008, and to today. But one thing is we know how to get through these difficult times, and because of where we've come from.
Yeah, well, that's and I definitely want to talk about that, because that is obviously on everyone's mind here today. You get on the social media feed, you get on Twitter, get on Facebook, get on anything, and I guarantee that 85% of the posts are regarding, the times that we're in today with the COVID-19. And so before we get there into that part of the discussion, I'd love to talk about the evolution of your business and going through some of those downturns, right? Just truly living through, or having your business live through and continue breathing through 2008, 2009 era. And, your business changed a lot over the years. You guys, you were self-defined as a value-add investor. And I guess my big question I would have as far as that, do you still consider yourself a value-add investor today, being that you are mostly in A-class assets?
Absolutely. So, there are what we call capital-starved assets in all the different asset classes. So, for example, our prize asset today is the Point on Harbor Island, where many people locally know as the place where Jackson's and American Social are located. But back in 2014, when we bought that, the location. It's a fantastic location. Yes. Across from the Convention Center, Amway Arena, and downtown. And it was only 25% occupied at the time. It was capital starved. It wasn't because of the location. It was because of capital. And so we bought that 115,000 square foot waterfront property for $7.5 million. But then we invested another $15 million in improvements to it to bring in American Social, the great office tenants we have, Starbucks. We have a marina, a very dynamic marina out there. And so we brought it back to life. And so there's still, even in the Class A sector, there's great opportunities to add value. And even more recently, in 2016, we bought the former Tampa Bay Times building in downtown St. Pete, which was 100% occupied at the time by the Times, and then they downsized to have a half the space, and they're continuing to downsize even more. But that was a building we bought for $19 million, and put another 10 million of improvements in it as we repositioned it into a multi-tenant building.
Got it. No, that makes sense. So I'd love to define what capital starved means, and in the example you gave. Let's use Harbor Point. Give us an idea of the firm that you purchased it from. Exactly, how do you get to that point, and then ultimately, how does that how does the building of the property being capital starved? How does that how does that relate to its low occupancy?
Sure. So owners own real estate for different reasons. Everyone has different motives. The person we bought it from was an individual who bought at a great price, but he also bought at a time when downtown wasn't downtown. Mm-hmm. So I think that just similar to how I described how in the late 1990s when I was buying real estate, people had the bruises from the 1990 recession. Similarly here, the views that I think the prior owner had on downtown were formed from the downtown Tampa we knew in 2001, 2002. I think he bought it around 2001 or so, or 2002. So that was a different downtown. So he had no intention of investing any money into that property.
Got it.
And so and when he bought it, it did have Jackson's, and it had another company that doesn't, Zell. Zell was a company that was there that occupied most of the remainder of the property. But when that tenant left somewhere, I can't remember 2008, 9, or 10 when they left. I don't remember exactly when. But when we found it in 2014, it only had Jackson's as a private tenant, and maybe one or two other small tenants. It was less than 30% occupied. But the owner, just his mentality was one that he didn't believe in putting money into the property for improvement. Remember, he came from a 2002 version of downtown. He couldn't understand why. And, it takes a lot of money. The tenants, like you said, we've put $15 million in improvements to transform it. So do you commit that kind of money if you came from a 2002 mentality and make that bet? Or do you just say, well, whoever wants to come can come? And most people don't come unless they receive commitments that there's going to be improvements.
Right.
So, but he still made a lot of money on his combined investment. He owned this building and the West End and did tremendously well despite his lack of additional capital investment.
So outside of just improvements to the building itself, we're also talking about attracting office tenants. Being able to commit to tenant improvements to the actual build out of the interior space is correct. If you're not willing to, there's other competitors offering these incentives and you're not, then ultimately, more than likely, you're not going to attract the primo office tenants that you ideally would want in that high grade of a building. Correct?
That's right. Yeah. And so the benefit we had was a great location and the views of the water where you can actually touch the water. You can go outside, go for a walk, and even touch the water. So that is something that none of our competitors downtown can offer.
So you speak to the the mindset of that owner. He purchased it in 2001. Downtown was a very different place than what it is today. It's grown by leaps and bounds. It's just it's a completely different city, and on the positive side. And so you guys got your start also buying as a value add investor. I know you're still a value add investor today, but buying B and C grade assets, or maybe in not as desirable locations as what downtown Tampa is today, right? And so how do you, when you're used to one particular mindset, again, using the example of this old owner of this building, how do you make that shift to understand, I wouldn't have paid X amount of dollars for that facility back in 2001, but today it's worth it. And I think a lot of us that have been in the business for 10, 15, 20 years, I think we all struggle with that to a certain extent, especially if we look at something, we could have bought that 8 years ago at X amount of dollars, or $5 million, and now it's selling for $15 million today. That's not a great deal. But from a high level perspective, I guess there could be some facts behind that. However, you're not comparing apples to apples at that point in time. So how do you pull yourself away from that?
Yep. So I think that's where travel is really important. Visiting other cities, downtowns, urban centers, and looking at the trends that are happening in those other areas. And sometimes the problem with being local is that you're too local and you have too much history behind you about the local market, and you can't see how things are changing demographically. In terms of business requirements. For example, the biggest shift today is that people want experiences. And I think one of the iconic representatives of this shift was about a decade ago, maybe 8 years ago, when Italy came out in New York City, it became a market and experience of a restaurant. And I know a lot of people want to start mimicking food halls and that Italy experience. But that was an indication of how people today are looking for experiences, not just the real estate or not just the property. And so experience, and I say combined with hospitality, is what real estate needs to be today. It's not just the property and location. It has to be a great experience for users. And it's only when you travel and get outside your market, you start seeing the compare and contrast to your own market. And then you can actually look at how you can make strategic investments. And again, we still do study the local market metrics for rents and other things. So we still have to work backwards. So we know where the rents can be and work backwards to see how we can be the better competitor in that marketplace with the rents that we're facing.
Got it. You know, you've done many different types of projects across multiple different asset classes, but is there a specific focus, office, we use the Harbor Point as an example. That's mostly an office building with some restaurant space. You mentioned the St. Pete Times, or was it St. Pete Times downtown or Tampa Bay Times?
The Tampa Bay Times building in downtown St. Pete.
Correct. That's office space as well. Is that mostly your focus? Based on your website, you guys have done a little bit of everything: country clubs, A-class hotels in downtown CBDs, and a litany of other things. But what is your core focus today?
I think it's assets that we can. There's no focus in terms of exact asset class.
Okay,
we're looking for assets that we can transform with a experience component. So, for example, we have a retirement community too. We develop retirement communities, and there we're selling the experience. And then, it's the hospitality component is a big part of every asset class. And so, if we can't transform that asset with a combination of capital and making the experience more dynamic, we're not as interested. And so, we have a lot of apartments we own. We have hotels. We in our portfolio right now, land development where we have single-family communities, particularly retirement communities, as well as office and retail.
Got it.
But I want to be able to provide the end users the experience. That's one of the key things that how I want to compete in the marketplace.
Got it. So asset agnostic. I mean, you guys you're opportunistic buyers, open to a variety of different asset types. So.
Yeah.
Got it. Okay. I'd love to learn how you guys, fared through 2008, 2009 era. What are some of the big changes and shifts that you had to make in your business to not only survive, but thrive and pull out on the other side, which a lot of folks, that's where they crashed. They crashed and didn't come out on the other side, or they were bleeding and they had lost a couple arms and legs along the way, right? It was pretty ugly period of time. Now that we're amidst another volatile time in the marketplace, not knowing exactly how it's going to play out, what the long-term effects might be, I'm sure that there's some deja vu happening to some folks that ultimately, weathered that storm in 2008. So I'd love to hear from your perspective exactly how Convergent, how you guys made it through, but also, continue pushing forward and growing your business there post 2008 era.
Absolutely. So I think there's two principles that I give credit to. One is it's extremely important to always remain positive. And it can be hard in those difficult times, but I've always been a positive person. But I looked at 2008 as my test. I looked up and said, I've read that book before, that spiritual book before. I actually thought about the book of Job and said, I know how this plays out. I know this is a test. And I just kept positive. And so I vividly remember the book of Job, and it said, this is what this is. It's a test to see whether my faith can be rattled, and it can't. And so I maintained a high degree of inner faith. And number two is reach out to the community around you. We're in this together. And the beauty of it was I was able to, I really appreciate how business partners, colleagues, and everyone else that we had business relationships with, we all banded together to work together, and we got through it. Of course, we had some hard times with lenders and bankers who were really, for the most part, being pounded up on by the regulators. It wasn't that the bankers were bad. It's that regulators were also down their throats. And so, as we know, shit goes downhill. And so we're on the other side. And so, but as long as you can laugh through that and that perspective, you can be positive and work through things. And so we were able to, we had our share of bruises. I think we had, about 4 or 5 deals that we struggled with. but we worked through things with our creditors. We worked through things with everyone in a positive way. I still remember one of my lenders saying, don't tell anyone, but you're the only one that's actually still paying us. Okay, well, I don't know if I could do that information, but at least I'm on your good side. And they actually ended up giving us a great deal on our debt payoff, and because they knew we were good guys, And so, but I was able to leverage a lot of relationships, and we can't forget that we're in this together. And so you can't look at people as enemies. You have to be able to harness, your relationships towards a common good. And so I think even today, we can't forget that we can't be selfish. I think the one attribute or quality, I think, of those that failed, not all, but some that failed, was their selfishness. They looked at themselves alone and didn't see that they're part of a bigger whole. And so we have to remember that we're not alone in this. We're in this together.
Yeah, no, that you make a great point. And I had some challenges during that period. And I think as I look back and reflect, I think that the biggest challenge that I had is I was here in the Tampa Bay area, and most of my networking contacts were in the Florida marketplace, and Florida was just a disaster all the way across the board. And I had a very hard time getting myself out of that Florida bubble and actually seeing that bigger picture. And it took me some time to truly step back and get away from all the negativity and actually see that there's a bigger picture here. There's lessons to be learned, and business and life goes on. But I'm probably one of those folks that it took me quite some time to actually realize that. And I always like to say, get my head out of the sand, because not that I was trying to ignore all the chaos that was going on around me. It just, there was so much out of my control, out of all of our control, and everyone I spoke to was also in a very similar situation. So it was very, very challenging mentally. But I think the one thing that brought me through that tough time, as you mentioned, your faith and just being positive and keeping that positive outlook, was really focusing on feeling good and health and fitness, and just the one thing I could control was my mind and body, right? Like everything else could be out of my control, but that's the one thing that no one could take away from me. And I put even more of an emphasis at that period of time. Not that I don't maintain a healthy lifestyle outside of that, but I literally spent all my time and energy feeling as good as possible, reading a lot of, positive books and, self-help books and things of that nature. And I still do it today, but I mean, it was a very concentrated effort, again, because everything else was falling apart outside of my daily life. However, so. Well,
you make an interesting point, because actually I have an interesting piece of data to look at. I ran my first marathon in January of 2008, my second marathon in January of 2009, my third in April of last year, and I'm supposed to run my fourth this weekend, but it got canceled. So the timing of my marathons and economic cycles is like a little thing. I wonder if I start running marathons when I think the economy is
not. No, that's fair. I ran my first marathon in 2009, the Chicago Marathon, during, which was still pretty rough times, right?
Yeah. So at the time I'd signed up for the 2008 one and the 2009 one. We hadn't just seen the full crash yet, and I signed up for my third one. We ran it last year, and the fourth one was supposed to be next weekend, and so it's somehow, like, I guess when I start feeling like things don't make sense to me, I start running, getting back to my physical fitness and getting my head cleared. And that is one of the things I do to get my head clear. I do remember going on a long run and having a hard day, a banker yelling at me, and thinking to myself, I got this, and I had some other vulgar thoughts in my head about that banker, but I had clarity after that run,
Yeah, there is not a better use of time as far as exercise and just release is as far as running. I mean, running is by far the best quick activity. You've got 30 minutes to kill. Go out and do a 3, 4, 5 mile run, however fast you are, right? And I can promise you that's probably the best use of that 30 minutes as far as getting a emotional release, a physical release, and just feeling better and getting more clarity. Anyway, I love it. I wish my wife got me in the running, and I've kind of falling out of running. I do a ton of cycling, so I picked up cycling over the years, and that's become like my release. However, you can't get as much of a workout in 30 minutes as you can in a run. So
yeah,
I miss it. But anyway, so I'd love to talk about how the things you've dealt with and the challenges you faced in 2008, 2009 in your business, how that's kind of carried over to today, and more specifically, what are some of the risk mitigation strategies that you guys have started to put in place as we move forward with this coronavirus and ultimately the economic impact and potential fallouts that might come as a result of it?
Yeah. So the key thing here is that we have, as landlords, have to work together with our tenants.
Mm-hmm.
So in our office and retail properties, we have to work very closely with our tenants and modify, adjust, and overcome. And that experience came to me from managing Class B properties. The difference in Class A and Class B is that in Class A, you have pretty sophisticated tenants. Yeah. For the most part, will be fine throughout cycles. But in Class B properties, you have to be able to address problems almost every day. There's something that comes up. There's smaller issues, there's smaller businesses, but it's big for them. And so when we used to manage Class B properties, the reason our properties got filled up and they thrived is because we were very responsive to our tenants. So when they had an issue come up, we'd be there, listen, and validate it. And after validating it, help find a solution and being flexible. And so whereas in Class A properties, landlords are mainly institutional, and institutional landlords don't have the same level of flexibility as entrepreneurial landlords like us.
Mm-hmm.
And so we have to think long-term with these issues and reward and support our tenants for their tenancies and find ways that we can help them grow. So for example, I'll give an example. We just had a meeting today with some of our restaurant tenants, and it may be the case that occupancy in the restaurants will drive down significantly, or if not shut down.
Yeah.
And so we're working on creating ways that they can start packaging food and selling to go and delivery products. So kind of like, we know what Fit Life Foods is, you go in there, it's already packaged. And so, let's use these kitchens to make healthy food options. If people are staying home, they still want to eat healthy and well. And so how can we create opportunities for them to package food? We also made a decision today on our property in Harbor Island to offer free parking. Just open the gates and let people come in and go. Mm-hmm. So if there's a pickup, to ease the ability to come in and get a pickup done without having to pull a ticket, validate a ticket, and not get dinged for paying, for parking on the way out. And encouraging people that, hey, let's come down here. If you just want to go for a walk and grab a drink, come down. Parking's free. And so those are some of the things we're beginning to implement. But we have to think with each situation, what will help the tenants in that space. I think the office tenants are going to be okay. Apartment tenants are going to be okay, but it's the retail and restaurant tenants that we need to find ways to drive traffic and drive their business.
Yeah. Yeah. Are you guys currently investing in any hotels?
Yes.
Yeah. So obviously that's the real one, right? That's taken. They've taken impacts over the last two weeks already, and it's only going to get more severe as time goes on.
Yeah. So our hotels are probably going to be, we're going to get beating there with some short-term losses, I think. Our hotels, for the most part that we have been relatively, resistant to recessions. But for example, we have a hotel in the Villages, and I don't think the Villages ever saw a recession before. But now with travel and the susceptibility of the elderly to COVID-19, I think that's going to see some downturn. We have a hotel in downtown Milwaukee that we're concerned with. That we were banking on the business from the Democratic National Committee being hosted in Milwaukee this year, and that hotel thriving from that. I hope that still goes forward, but who knows what the restrictions are going to be on that now, And so we're very concerned about Milwaukee. The hotel portfolio, we have 5 hotels right now.
Okay.
And,
what does that strategic preparation look like outside of just having liquidity, right? I mean, what is there anything else that, speaking to the hotels, is there really anything else one can do, such as, a company as yours, other than just making sure that you've got, liquid capital reserves available through this troubling time? I mean, are there any other approaches you guys are taking?
Yeah, I think on the hotel side, I'm hoping that there'll be some federal relief, as well as maybe the lenders themselves working with the hotels.
Yeah.
If we can get some relief on the cost of debt or deferring payments. So we're going to work creatively to see how we can create a deferral pool.
Yeah.
And then, that's one part of, because we understand finance really well, one of our core strengths is we understand finance really well. So we can create these structured products as long as our bankers can get them done despite regulation, So I think that federal relief in terms of how regulators will review these strategies to defer losses in the meantime will be very important.
Yeah. So I want to flip to the other side of the equation here. And I don't want to be insensitive to everything that's going on, because I do think that things are going to get worse before they start getting better. And it's going to be even more impactful than any of us can think. And I hope that's not the case. And I'm not a conspiracy theorist at all. But I do think that we're just in the infancy of ultimately how this is going to play out and the trickle-down effect that it's going to have economically. However, we all know the old adage, that you buy low, sell high, or buy when there's blood in the streets, right? Do you think that there ultimately could be some good buying opportunities, not in the immediate future, because obviously real estate moves way slower than the stock market, which is a roller coaster in and of itself. But do you feel personally that there could be some good buying opportunities here over the next 12 months as a result of what's going on now?
Yeah, I do. I think that, especially on the hotel side, and even retail, I think it's not just our restaurants, all retail is being impacted right now. And so I think retail's already been suffering through all sorts of changes. Yeah. And I think, the biggest issue is that we've seen this peak in retail rents. And so that's been driving, valuations really high. And I think we're going to see some cyclical pullback in those rental rates as business owners say, you know what, I can't budget for that because I need to make sure I have reserves. Into my P&L, I need to make sure that I can budget more significant reserves for events like this. And so, although, so I think that in retail and hospitality, hotels, we're definitely going to see that pullback. I don't know about multifamily though. Multifamily still seems resilient, although the recession should cause some concerns if a recession occurs in terms of where rental rates can go. Yes. A big part of the formula in the commercial real estate space is when you look at cap rates. People use cap rates as a method of valuing commercial real estate. But from my, one of the things is that people don't spend enough time studying I call it the calculus behind that formula. Just to be a little nerd here. So the formula for mostly used for real estate valuation is income, trailing 12-month income divided by a cap rate. That is actually the formula for what we call a perpetuity in corporate finance. And so, but that formula embedded in it, in the cap rate, is a certain growth rate, right? And so the lower your cap rate implies the higher your growth rate. So if growth is slowing, then cap rates should rise. And so I think that's where we'll see the effects, because I think cap rates do need to rise because rental growth rate, can't be forecasted anymore. Mm-hmm. And what we look at is, what's always important to look at when you look in the commercial real estate sector is look at the publicly traded REITs. Because what happens is the public markets are forward-looking and they look at growth rates, whereas the private sector is always looking at the rearview mirror, trailing 12-month, right? Well, trailing 12-month, like we all know in all investments, past performance is no indicator of future results. Mm-hmm. So trailing 12 months is very flawed, but that's how private investors always look at things. Whereas the public investors look forward, private investors look back. Mm-hmm. And so, so I think that the growth rate will be impacted. We're going to see even though interest rates are dropping, in theory, cap rates should rise because growth rates are diminishing.
Mm-hmm.
And the biggest issue we have today with low cap rates is that they presume that there's no risk. The other formula way of calculating cap rate is your risk-free rate plus your risk premium.
Mm-hmm.
And real estate has all sorts of risk premiums associated with it, including not only credit risk, but also liquidity risk. When I own real estate, I can't just turn into cash overnight. It takes me probably 6 months sometimes to turn that investment to cash. So there's liquidity risk, credit risk, and all sorts of other risks that are there. But with low cap rates, you're basically assuming there's zero risk. And I think that as these risks and start becoming more apparent, cap rates are going to rise. I hope that's the case. But we'll see, so.
Yeah, no, I mean, speaking to multifamily, I think some of the other risk just from a higher level is, especially when you really speak to like B and C class facilities, and this is assuming that there's no federal relief plan that gets put in place in the near term, are folks that live paycheck to paycheck, which we know is a large percentage of the population. Those folks that can't go into work, or the restaurant got shut down, or now they have to stay at home because they can't afford a babysitter, and all the public schools are shut down. I mean, there's just all these ancillary outside effects that are kind of mounting up, and will create a lot of financial hardships for that class of folks. And I'm trying to remain very conscious and optimistic that the government comes up with some type of federal relief plan that could ultimately help those folks, because I think that there could also be a very large, impactful fallout as a direct result of that. Those folks that truly can't afford to pay their rent. There's a number of states, we talked about this before we started recording. I think there's at least 2, and maybe there's 3 or 4 more, that not necessarily the entirety of the state, but individual counties or cities that have basically put a halt on any type of evictions. Right, eviction court is halted, and no writs are being granted. And so anyway, it's going to be very interesting in the long term, and wishing everyone the best. Right, I wish you guys the best, and everyone that's listening the best as we roll through these very uncertain times. But and I think that back to the point that you made, Santosh, about whether 2008, 2009, just you can't change anything that's going on around you. You can prepare. You can be aware. But really, the important part is stay positive. Right? There's going to be lessons that are learned here. There's going to be opportunity that's created, and it's just it's a point in time that a lot of us haven't gone through before, and we'll take it day by day. Just keep a positive outlook, and just keep rolling forward.
Yeah, and as landlords, our focus is to stay positive and work together. It's important. I hope that other people who go through hard times have landlords who can be more understanding and work together with them.
Yes,
I think it's important that people put their best foot forward. I think that the more people that take advantage of the situation, it hurts the overall.
Like the ones that are hoarding hand sanitizer and selling it for $80 a bottle.
Exactly. So if you have, like, an example in that eviction issue, if you have people who have jobs who are taking advantage of the situation by not paying their rent, it hurts the overall. We have to think about not just, again, it's not being selfish. And, that's a big part of my view. And I think it's led to successful outcomes when we get the selfishness out of our heads.
Yep, absolutely. Well, fantastic. I appreciate you being transparent and also somewhat vulnerable as we talk about these very sensitive issues, Santosh. It's great feedback you provided. I'd love to move into what I call the lightning round now, and this is where we get a little bit more intimate with you and get to better know you as a person. And so 6 questions here, short questions, looking for 6 short, concise answers. And so let's get rolling with it here. The first one, your biggest fear, what is it?
So I have to tell you that my biggest mantra is to have no fear.
I like that. That's the first one. That's the first time I've. Yeah.
And the thing I actually apply is that anytime fear is a factor in your decision making, you're going to make the wrong decision. So always try to make decisions out of strength. So that's actually the one thing. I hate to be cliche, and those who know me know that fear will never be a factor in any decision I make.
I love it. Yeah. I love it. How about your one biggest regret?
Biggest regret. I think we think about, from a business standpoint, the deals that got away. And so we do have a few of those deals where we look back and say, there's a property across from iPlaza where there's an apartment building that's built today. There's a property where Nissan Plaza is, and we had to buy that whole block. There's those few deals that got away. I think we always remember. But from a personal standpoint, I married the love of my life and my college sweetheart, and I don't have personal regrets, but
Yeah, that's
from
good.
business side, we always think about the deals that got away.
Yeah, no, fair enough. How about the most influential business book or just book in general that you've read?
Sure, that I can. It's a book called Buffett: The Making of an American Capitalist by Roger Lowenstein. It tells you all these great stories about his best deals he ever did, and those lessons still apply today. In fact, the one story in that book is about when Warren Buffett bought American Express when it came down, and just last week I bought a bunch more of American Express. But that story is a great story.
Yeah, fantastic. So outside the daily work grind, what do you do to decompress? And we talked about running, but is there anything else?
So running's big, and it's meditation. And so running, for me, is a form of meditation as well. But I make sure I get out into the nature, go hiking. I think really just being grateful, practicing being grateful. When you're in nature, how can you not be grateful for this great weather, great place we live in? We live in paradise. And
we do live in paradise.
So we can't, being grateful for that keeps my perspective in check.
Yes. How about the one thing that you can't live without?
Oh boy, I was not prepared for that. One thing I can't live without. Coffee. It's coffee. I'm a coffee junkie.
All right.
I can't start a day without coffee, so.
Like a special coffee concoction, like bulletproof coffee, or just straight black coffee?
It's just straight. Actually, I'm a Starbucks junkie. The Pike Place brew. That's just straight Pike Place brew is all I need, and I can't start a day. My kids will not start a day without me having my coffee.
Is it grumpy Santosh before coffee gets into the bloodstream? Is that what happens?
Impatient, I call it.
Yeah. Fantastic. How about the last one here? If one day you woke up and just decided that you no longer, wanted to do what you're doing today for whatever reason, where would you focus your time and efforts and energies?
So on one side, I've actually started pursuing one of those things, and that's producing films. I've actually now gotten to where I produce 5 films. That's always been a passion of mine, and we've been successful in the filmmaking side. But I think longer term, I'm actually dying just to become a monk, So go off hiking into the mountains and meditating and, just getting back to my inner self. But right now it's filmmaking. Ultimately, someday you're going to find me on the mountaintop somewhere.
Yeah. How's your wife feel about that one?
Yeah. She's not supportive of that. She thinks I'm crazy.
Different discussion. Fantastic. Well, Santosh, this has been a lot of fun. I really appreciate you coming to the show and spending time with us here today. And folks, if you want to learn more about Santosh and his group, you can go visit their website. It's convergentcap.com. Again, convergentcap.com. I'll be sure to put that into the show notes. So Santosh, that's all we have, my friend. Really appreciate you coming on. I'm wishing you and your team and all the different tenants and just folks that you guys service, wishing you guys all the best through these these next couple of months, and hopefully all come out on the other side scar free and move on with our lives. So just wishing you all the best.
Appreciate it.
Yeah, so thank you guys for tuning in to this week's show, and until we meet again next week, this is your host Kevin Bupp wishing you huge success. You guys take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.